Hi everyone, this is Tim Melvin of the Tim Melvin Deep Value Letter and Banking on Profits Report, coming to you from down here on a very nice, warm, sunny Central Florida day. We're well into my favorite part of the year right now. We've got sunshine and heat, giving us an excuse to head to the beach, the pool, wherever it is we like to go. And there's plenty of those spots down here, fortunately. The wife and the youngest have been taking full advantage of the local Disney water park so far this summer. It's my favorite time of year, no matter how hot it gets out there. I just enjoy summertime. Now, as we come here to you here today, the big discussion is what's going on in Greece. Are they going to have a deal? Do they have a deal? How close are they to a deal? By all measures, it looks like right now they're pretty close, and the deal may actually get done before the end of the month to keep Greece out of default and safely into the EU. However, they're having to agree to some concessions, delaying retirement, making some changes to retirement plans, and that's not sitting well at home. There are some, they're just protests so far. They're not the riots in Athens that we saw the last time the Greek debacle was moving markets. But it's at the front of everybody's thought process right now, and we'll see how it plays out. We continue to own Greek banks. I think right now, after doubling down once, we're still at a small loss on them. No intention of doubling down again. We're just going to ride this and see how far it goes. We've got some great co-investors in this thing. These things like David Einhorn, Prem Watsa, Wilbur Ross. So we feel pretty comfortable that over the long run, no matter what happens to Greece, what idiotic thing that they may do with their finances in that nation, even idiots need banks, and I think the ones that we own will in fact survive and thrive over the long term. If I'm completely wrong, it's a small loss. If I'm even vaguely right, it should end up being a huge gain, and that's sort of how I like the odds when we buy these things. So we got some strong housing numbers over the last week. These are actually very pleasant numbers, going along with my thesis that housing is not going to put in a V-bottom, but just a nice, steady improvement over time. But we're off to a good summer start. We've got existing home sales jumped to a 5.5-year high. Now, don't get too excited. That's really still well below the 2006, 2007 levels. So there is a long way to go, and it's going to take some time to get there. We had housing permits jumped up to about an 8-year high. New home sales are the best since 2008, and on average, home sales prices climbed about 2.2% in the past month. All good numbers. The builders have to be pretty excited, and indeed the Builders Optimism Index came in at a very nice level over the last week as well, indicating that the builders are optimistic. Strong building residential properties to go along with improving strength in the commercial real estate market is good news on a number of fronts. One, that's a powerful sign that the economy is in fact getting better. Maybe we can get some real permanent job creation out of the construction industry. That would certainly be exciting. And I don't have to tell you that it's just fantastic news for our small banks. They're doing very well on the commercial lending side. If we see a pickup in residential buying and lending as well, that will be significant. The biggest, most favorable indicator to me that I took out of these last reports is first-time buyers appear to be coming back. They've moved up to 32% of the market. Still not at the 40% plus that is the norm, but it's getting better. And that all-cash investment buying is starting to decline a little bit. Now, of course, remember, this gives a lot of support to those who think the economy is going to strengthen in the second half. And as wonderful as that sounds, it's the old bad news, good news things. Yeah, that gives the Fed an incentive and an ability to raise rates. And indeed, Fed Governor Jerome Powell said he thinks we could actually get 2 rate increases this year, one at the September meeting and then one again at the December meeting. I don't know how the markets are going to react in the short run to that first bump up in interest rates. If I was a betting man, and I don't bet on these kind of things or make strong predictions, but I would think it's going to be that second rate increase that would roil the bond markets and eventually the stock markets even more so than the first. As we sit here, we're still flirting with all-time highs in the stock market. Bonds have been coming off a little bit. And I'm not a market timer, and I don't make predictions, but it's hard to get real excited about the current environment in the stock market. You've got the Value Line Median Appreciation Index. It's still staying at about that 35% level. That's below the 55% level where you should be a seller, and about a third of the 100% level where you should actually be a buyer of common stocks, according to the academic research studies. When you look at market cap to GDP, Warren Buffett's favorite indicator, that's still at very high levels. And remember, he said not too long ago that if interest rates start to rise to more normal levels, we will in fact find that the market's trading at some very lofty valuations. The only thing that you can use to even vaguely justify The current pricing in the stock market is the incredibly low interest rates that have been held down by the Fed. If rates begin to normalize, that's trouble for the stock market, in my opinion, and apparently Warren Buffett shares my opinion. So all those measures are still very high. The Tobin's Q ratio is still up there at levels above 2007, but still below the outrageous levels of 1999. I don't know that we'll ever really get back to those. All in all, the market, we can argue, is it fairly valued? Is it moderately overvalued? Is it grossly or horribly overvalued, as James Montier put it? What we can't even begin to discuss is the stock market cheap? Based on earnings, price to book, price to sales, price to cash flow, dividend yield, it's not cheap. Okay, this is not an exceptional opportunity such as those Charlie Munger talks about. He sits on cash until he finds an exceptional opportunity. If there's an opportunity in the stock market outside of one specific sector that I'm going to talk about before I'm done here, I certainly do not see it. The broad market is not a bargain. We're finding some little things to chip away at. We're still holding very large levels of cash in both the deep value and international deep value portfolios, and doing slightly better at getting cash invested in, of course, in the bank stock portfolio, which is fully invested, and the income portfolio, which is mostly fully invested. Now, speaking of which, went to the beach this last weekend. I like to do Father's Day on the beach. Went over to our favorite little beach town here in Central Florida, set up camp on the beach, and I did some light reading. And among my reading was a study by a fellow by the name of Jack Vogel. It was posted over at alphaarchitect.com, and he looked at dividend stocks picked based on an above average yield and a very low enterprise value to EBIT, earnings before interest and taxes ratio. It performed extraordinarily well in his study, and he looked at from 1964 all the way up through 2014. So he's got a lot of data points, a lot of time, and it really did a nice job. It beat the market rather thoroughly, earning about 16% over that period of time. That is a measure we use in the income portfolio. That portfolio is beating the market so far this year, providing a dividend yield of over 7%. And if we get just a little pullback and get some, we've got, I think it's about 15% cash in that portfolio. If we can get that back in, we like to stay fully invested into some quality stocks. We bought one last week, but haven't found anything else since to add. We can jack that yield up and maybe get the total return even a little bit better. So if you're seeking income, the income portfolio is part of the deep value investing newsletter, so you might want to check that out. Now, stock markets over the last month, they're kind of flat. The S&P 500 is down 27 basis points. The Our World URTH ETF, which is designed to replicate the MSCI Global Index, is down about 1.74. You know what's not down? The index of community bank stocks, our old friend QABA. It is up 6.53% over the last month. Now, I'm sure that even if you didn't see the movie The Perfect Storm, you kind of grasp the idea of a perfect storm, everything coming together at one time to produce an incredible event, or as Charlie Munger might call it, an exceptional opportunity in the stock market. As Yogi Berra once said, you don't have to swing hard to hit a home run. If you have the timing right, it'll get out of there. Now, I think in the small banks, we have the timing right. We have for a couple years now, and there's still plenty of time to come. You have something of a perfect storm going on in the small bank sector of the economy. You have improving loan demand, especially from the commercial side. Commercial real estate and C&I lending, commercial and industrial, has been very strong, and commercial real estate is, again, it's not a V-bottom or any runaway recovery, but it is continually grinding higher, improving. We're seeing rents go up across all types of properties just a little bit. Okay, we're seeing occupancy rates creep up a little bit, so things are pretty good in the commercial lending side of things. Now, we're seeing signs that for the first time in a long time, those banks that have more of a residential focus may also start to see some improved loan demand. Of course, all banks across everywhere are reporting fantastic demand on the consumer side, particularly auto lending. So you've got decent loan demand out there in spite of a grindingly slow economic recovery. Credit has improved dramatically over the last 5 to 6 years, to the point where most of the banks are super healthy with very low non-performing assets ratios. They've rebuilt the equity in the banks to one of the highest levels in decades. And the regulators have made them do that, by the way. They've raised those capital levels up quite a bit. But you're looking at equity to asset ratios in a lot of these little banks that are well over 10. That's kind of my floor, usually is 10 when I'm going to buy one of these little banks. I don't want to see too much leverage in these things. So they're not very levered at this point in time. Adequate capital. Loans are performing nicely, seeing some increased loan demand. Then the one problem that they're having is record low net interest margins, okay? And that's what you live and die on as a banker. You borrow low, lend at a higher rate, you make the spread. Well, that's the lowest level it's been in a very, very long time. If the Fed starts to raise interest rates, every little tweak up in interest rates improves the net interest margin for these smaller banks. Rates start to go up, it does in fact become an absolute perfect storm. Then we can pour some gas on it with the changes that were implemented on May 15th to the small bank holding company regulations. Previously, they only applied to banks below $500 million in assets, and they were allowed to use higher percentages of debt, up to 75%, to finance an acquisition. They could borrow money on favorable terms at the holding company level and pass it down to the bank to buy back stock, pay out shareholder dividends, all kinds of things that are good for us as shareholders. Well, on May 15th, it went from $500 million to $1 billion to qualify as a small bank holding company. That gives these banks between $500 million and $1 billion in total assets access to capital on very favorable terms, which they can use to do things like buy banks, other banks, pay dividends, and buy back stock. And here's what this hung a for sale sign on every bank with less than, say, $350 million of assets. You don't want to buy a bank that's going to push you over the $1 billion mark, so you no longer have these favorable terms, and there's a few new regulations that kick in over $1 billion. So you're going to want to limit yourself to, $600 million bank might buy a $350 million bank, $700 million bank might buy a $150 to $200 million bank. You're going to try to stay under that $1 billion asset mark. But all those banks under, say, $350 million, where a $500 million or even a $600 million bank could buy them, they now have a for sale sign on them because there is additional financing capability to get the deal done. Everybody wants to grow as much as possible to spread the regulatory and now the need to spend money on technology to stay competitive in the space, spread that over as large an asset base as you possibly can. So these sub $350 million asset banks are much more attractive targets, and there are just a ton of them with super clean balance sheets, strong performing loan portfolio, and there's a bunch of them that actually have, I think we found 27 or 28 when we did the exercise, I have to go back and count, that actually have an activist or smart money shareholder, a known bank stock long-term investor, as a large stockholder of the institution. As I said before, it's like getting dealt aces in every hand playing poker when you buy these little banks that also have an activist involved in them. Lady Luck's going to get you some of the time. You're not going to win every hand. Somebody's going to draw out trip kings or something like that against your aces. But you are going to win the majority of the hands. So as long as you keep your bets properly spread, you're going to make a lot of money over time. So if you're not in this space, the question you have to be asking yourself is why not? Our buy list was 23 or 24 names again this week, all trading below our cutoff of 90% of tangible book value, most below our initial buy level of 85% of tangible book value, non-performing assets under 3% and trending down, equity to asset ratios over 10. You can still assemble a nice portfolio of these things. Get a market hiccup, you'll be able to buy a ton of them in here. So this opportunity in small banks is going to go on for a lot of time. There's going to be a lot of money made. You really should get involved with this. We'll put a link to Banking on Profits in the comment section. You can check that out, see if you want to sign up. I hope that you do. Anyway, got to go enjoy the rest of this summer afternoon and evening. Have a little bit of work to do. Then it's off for some Florida Collegiate Summer League baseball and watch the Winter Garden Squeeze. We're hosting one of their players for the summer as he tries to become a better ball player and maybe catch the eyes of some pro scouts in the Wood Bat League down here. A lot of fun. If you've never been to one of these and there's a league in your area, you should definitely go. By the way, I don't try to stop talking books because people complained about it, but the first Jack Ryan book since Tom Clancy passed away has been written by Grant Blackwood, who's a very good writer on his own rights and has worked with Mr. Clancy before. That book came out Tuesday. I'm going to start reading that this evening, and it's probably worth checking out. It's a good series, and I think Mr. Blackwood's going to do a good job of continuing the tradition of that series. Anyway, that's all I've got down here from Central Florida this week. I'll have another video out to you next week unless something goes crazy like it did last week, and I'll talk to you guys soon.